Good morning, everybody. Welcome to our panel. In 2024, we're seeing significant activities in the Asian hedge fund industry. In 2023 and 2024, we're seeing an increase of new launches from 18 to 30 in Hong Kong and Singapore, marking a 75% increase. This is very exciting, and we're also seeing a lot of allocator interest in the Asian hedge fund industry. And today, we have 4 esteemed guest speakers with us. We're going to dive into how to uncover Asia's best emerging talent. So Charmaine, you sit at the forefront of hedge fund managers. All of the new launches go to your radar. And can you tell us some of the observations that you have been seeing in 2024 in the new launch space?
Thank you, Amy. I'm Charmaine. I head our Asia investment team at Blackstone Multi-Asset Investments. We run about 80 billion in assets under management, primarily invested in third-party funds globally. So we're open architecture. And in response to your question, I would say that in Asia, we're definitely seeing a pickup in launch activity. Yesterday, I heard a stat that we're tracking at 3.4 billion of commingled launches in Asia this year, which is a recent high. And there's also a slight difference in what we're seeing. So historically, a lot of the large launches were in long-short equity, fundamental long-short equity, a lot of China-focused launches. I think this year we've seen a very large Asia multi-strat launch. We are seeing a large quant launch in the pipeline, a big Japan launch, some event, relative value launches. So a very diversified mix of strategies. And the one other major trend that I want to mention is that we're seeing a lot of launches in SMA format, where a fund will launch with 1 or 2 large SMAs and maybe a small commingled fund as well. And I think that speaks to the growing appetite from allocators for SMAs. So, of course, the major multi-strategy platforms, the millenniums, and of which maybe over 10% of their capital is now allocated to external SMAs. But you've seen the rise of other platforms, and we've got many of my peers here as well have become very active SMA allocators as well. So I think that's a trend that we don't see going away anytime soon.
Okay, interesting. Yes, we're definitely seeing a lot of multi-strats, a lot of different strategies apart from your equity long-short, and less so China-focused, being in the cap intro seat, as well as SMA allocations. So moving on to you, Curtis, you also work with a lot of new launch managers. From an Asian allocator perspective, can you share with us what are some of the criteria that you have when it comes to assessing managers?
Thank you, Amy. This is Curtis from Boothbay. I'm based in Hong Kong, running Asia for Boothbay. Our aim is to really create alpha-driven, uncorrelated strategies, overall portfolio. So really 3 things, right? 1, we want to have minimal beta. It doesn't just mean market beta, but sector beta or even factor beta. We want to have fair tight drawdown type of strategies. It doesn't mean that we are going to redeem a strategy at a very tight drawdown manner. But before we underwrite a strategy, we have to know the vol expectation and also the drawdown expectation. It might mean that we customize risk limits, versus the commingled vehicle. And then we want to have a very diversified portfolio. So we look at strategies, not just like equity, fundamental, long-short, quant strategies. We have event-driven, macro, fixed income RV, and even like commodity, onshore, offshore up. So we tend to look at a lot of different diversified strategies.
Mm-hmm. When we spoke, you mentioned about communication, some of the soft side of things where you value authentic communication in a manager. You like the fact that they report the good and bad to you. Can you just elaborate a little bit on that so that our audience can take notes?
That's a very good, interesting point. So ultimately, our job is to distinguish skills versus luck, right? For example, very often I will take out the track of the manager and then look at the 3 biggest drawdown, and then ask them what happened, what they did, etc. Right? And it's very important for us to judge whether it's recurring, right? So manager being very honest and really guide us through how things happen, etc. That's very important. And in that case, like marketing pitch wouldn't work, right? And communicate the good and bad, and also bad doesn't mean it's really bad, right? It may be bad in the past, but it might be good in the future because you've learned a good lesson, right? So that's a very, very important thing for us.
And you also mentioned about if a manager crafts a very, perfect story, if it's like too perfect to be true, that's not something that you like, right?
I think it could be a red flag to when it sounds like it's too perfect to be true, right? So we try to gel everything from what they say to the track, right? We want, for example, daily track for different strategies when you talk about something and it might not be shown on the track. So we tend to be very careful on those.
Yeah, understood. And Derek, I want to ask you a question. So you're based in the US. You're just so far away from Asia. I understand that you travel here about 2 times a year. So how do you go about in assessing Asian managers being so far away?
So we've been here for well over 10 years. So we come about twice a year. I would say 10 years ago it was actually a little bit easier because it was a very small community. You knew the talent. Everyone kind of knew each other. It was a little clubby. Now with the talent that's kind of rolling out of the platforms and all the new strategies, it used to be maybe multi-strat, equities, things like that. Now you have relative value macro. Now you have a lot of quants. So the strategy breadth has gotten a lot wider too in Asia. So you have to have your finger on the pulse of the market. So we do it 2 ways. So one, we have a group with boots on the ground in Asia, in China, that kind of speaks the language. Kind of they have their finger on the pulse of the market a little bit better than we do, so they help us. But at the same time, I have a dedicated analyst to Asia on my team, and now he kind of looks more like a pod shop business development person, right? Instead of being the analyst and knowing the 10 shops. He has to have calls with you. He has to have, he has to be in the market because the big platforms are scooping up the talent so fast. We have to get to that talent just as quickly, or at least make our argument to why they should run money for us instead of maybe somebody else.
Mm-hmm. Yeah, when we spoke, you mentioned that you have recently rolled out an SMA program. Can you just elaborate a little bit on that?
Sure. So we teamed up with the University of Texas Investment Management Company about 1.5 years ago. We saw the rise of the platforms. We liked the business model. We liked the risk-adjusted returns. There's certain things we didn't care for in some of those structures. A fair amount of leverage. The lockups, the fees, all that kind of stuff. Some of the things, but a 3 sharp is, really appealing to a lot of people. So we said, why can't we do that ourselves? So we went and we partnered with a group where we created our own platform. And now, especially in Asia, that allows us to be earlier, faster. We set up the same risk box as the platforms and things like that. But now we get the transparency, we get the control, we get to lever it as much as we feel comfortable with. And that gives us a lot more comfort of entering the space.
Right, okay. So yeah, it is true that SMA allocation is really on the rise. And John, moving on to you, I want to refer back to our conversation last week. I think one point that really stood out to me was that Albourne is equally as active in the newly launched space as your peers. And also, you would conduct unrated research on new launch managers. I think this is absolutely fascinating. It would be beneficial for the audience to understand a little bit about the process behind this.
Yeah, thanks, Amy, and thanks for the invitation to be here at iConnections. And actually, it's interesting, so in that conversation, there is an element of sort of dispelling perceptions around as a consultant that we only cover large funds. So just break a few perceptions. So we're kind of often known for covering hedge funds. Actually, we cover a lot more private market funds. Over 7,000 investment due diligence reports on private market funds available to our clients, and over 3,500 hedge funds that we cover. And just because of that breadth of the hedge fund coverage, the majority of those are smaller funds in nature. And because of the breadth of our client base, they are focused across the lifespan of underlying fund managers, seeding managers. They're there at launch. They're there. They want to get founder terms, secure capacity, And so we're looking across that full spectrum to the point we do a lot more rated research. The majority of those 3,500 funds are rated, but responding to recognizing how we can empower our clients to be the best investors, part of that is to have visibility into our process. So when you think of our funnel of really evaluating the full landscape of managers that are coming to market, we want to allow our clients to know who we've met with. And there are a lot of funds, the majority of new launches ultimately fail in the longer term. So, I mean, it's tough to reflect on, but the reality is it's not an easy business model to run a hedge fund. And but we want to make sure that our clients are aware of who's in the market, so that from a sourcing perspective. So we do publish what we call NR0s, so not rated, zero conviction reports on funds that we've met with or we see. And so there's several hundred a year that we'll be looking at, that we'll put those out just to make sure that essentially people can see everything that's in the top of the funnel. But then we're rating, hundreds of managers a year from that process. We actually, because of there's a perception that, Albourne maybe it works with only these very large investors that are only looking at the multi-billion-dollar firms. But, across our endowment foundation clients, we advise almost half the top 40 university endowments in the US, or a lot of private banks, wealth management groups, some fund of funds, where we support their on the ground, so boots on the ground. We have more than 40 investment professionals based here in Asia, and so really making sure we've seen everyone in that process. And so we will be collaborating with managers as they're starting to decide. So it's our pre-launch phase. And we'll end up doing actually quite a lot of not just investment due diligence, but operational due diligence at that stage as well. So even before they've selected their service providers to support our clients who are going to do seeding, particularly also when someone's looking, they may be spinning out of a platform to do SMAs. We're doing a lot of work on managers that are only raising capital in SMA format. So that's definitely a theme that we're seeing. And in some of those situations, it just makes more sense to start in those instances if we haven't spent much time with the manager, just to give color around what the manager's trying to do. Again, partly so that we maximize the utility that a client has in terms of understanding who's out there. If they're visiting a city, they don't just want to see the highest conviction, high quality names. They want to be able to see the breadth on a particular, if they're traveling twice a year from the US to Asia. So that's.
Well, there's been 30 new launches in Hong Kong and Singapore year to date. So does it mean that you would speak to all 30 of them? You would conduct research on all 30 of them?
Yes, that's our objective. Yeah. So our objective is to, we were just talking before, saying about meeting with 4 or 5 managers every day, and our team in Hong Kong are literally meeting with many managers every single day of the week, and it's that's our goal.
Okay, thank you. Well, I think the next question that the audience would be very interested to know is what are the allocators doing? What do they want to invest in Asia in 2025? And how does Asia play a role in their entire portfolio construction? Are they increasing or are they decreasing? So Charmaine, back to you. Yeah.
Yeah, so in Asia, we're very flexible. We invest in high net equity strategies, low net equity strategies. We've invested in quant, we've invested in macro, we've invested in credit. I think what we're really looking for in Asia is just best in class managers in each of these strategies. And we're also looking to partner with someone early on in their life cycle usually. And that way we can negotiate favorable terms, we can negotiate capacity for the future. In the equity space, we do a lot of SMAs, and so we'll try to negotiate that sort of vehicle as well. The one other thing I would say is that we're always looking for what we call good neighborhoods. This is Blackstone speak, but neighborhoods or sectors where we think it's very alpha rich. And so, for example, earlier this year, we invested in the equity space in an Asia semiconductors focused manager. We just think that given the trends that we've seen in AI, given that valuations have come up a lot, it's a great space to go long and short. Another example of an alpha rich area that we invested in earlier this year is Japan FX and rates. That's an area where there's been very little volatility for many, many years, but coming into this year with Bank of Japan being one of the few central banks in the world looking to raise rates, we see additional opportunity there. And so that's how we look at Asia when we're evaluating strategies.
So overall, are you increasing or decreasing Asia exposure?
I expect next year we're going to be increasing. About 2 years ago, we reduced the count somewhat, and I think next year it should be coming back.
Sounds great. How about you, Curtis?
We are definitely increasing. We have 35 allocations in Asia. By the end of the year, we'll probably hit 40. And the area of focus is really being very localized and specialist, right? We're a big believer in that. I travel to Singapore every 2 months. I was in Tokyo last week and the month before as well. So we're very, very active in looking at specialist, localized managers. One of our top 3 P&L generators globally, out of the 140, 50 allocations we have, is a manager sitting in Asia, and he's spent quite a bit of time not in big cities, but like in a small city where he has an edge, right? So we try to be very thoughtful on where people have edge and all that. And it's very similar to Charmaine. We try to be very, very early on as well. We have quite a few examples where we are day one with the managers. We have a manager where we're day one. We have when they were running below 20 million, we're in. Now they're running 500-600 million. We have another manager where like 6 months ago they were running like less than 100. Now they are approaching like also 500 by the end of the year. So we tend to be day one in SMA allocators in those managers.
Thank you. Yeah, you're very open-minded. That's very good to know.
Yeah.
And now on to you, Derek.
So I would delineate things a little bit. So for a big state pension, your equity asset allocation, by definition, ours is MSCI ACWI, right? So we have to have an emerging markets, and we separate China and ex-China. So we have to have an allocation in China and broader Asia. So we do have a specialist model, but so in long-only space, like we're always allocated here and we're always active. We're 100% active in this space. So we're always looking for new managers in that space. In Hedge, we've been here a long time. I do think, just based on this last trip, I do think we will be increasing our allocation, but it's going to be, I have to think it through a little bit more because you are seeing these rollouts and you are seeing managers that have run in the risk box of these large platforms. But I need an additional premium that I can get in the US. There's volatility here, which is the fuel for alpha. It doesn't mean that it's by definition more alpha, but it gives you the opportunity to generate alpha. So I need to generate a higher return here than I do in the US. At the same time, I don't, when you're dollar long, dollar short, perfectly market neutral, I don't want to just take the same deleveraging risk I'm taking in the US. So I need non-correlation. I need something different, something new. And so as we're seeing these PMs roll out, we're looking for something different. And the last thing I would say is we're very interested in Japan, but in Hong Kong, I met with a platform that's hiring something like 20 Japan PMs. I didn't think there were 20 Japanese PMs in the last 5 years. So people are is it really good talent? Is it really fresh and new talent? I don't know yet. And so you have to be a little bit careful. Even though Japan's really interesting and really hot, finding actual talent that's run money there is hard.
Thank you. And then John?
Yeah, so just thinking about kind of our clients' allocations to Asia. We obviously have a lot of clients based here in the region, but I'll focus on kind of ex-Asia, and what we're seeing. We have a large team here. We're certainly kind of believers that the hedge fund market ultimately relies on deploying risk capital into inefficiencies, as you're saying, like to extract a return that you can't get elsewhere, and that the Asian markets have that opportunity that deserves an allocation in our clients' portfolios. Whether they get that through global platforms that can access versus specialists really comes down to the implementation profile of a particular investor. I think an important theme when you go to, let's say, like in the US, there's a lot of states where in the public equity books, they've now explicitly running an ACWI ex-China mandate. And so that has had knock-on consequences, I think, in terms of just the appetite for bringing new specialist Asia funds into the portfolio. When it comes to hedge funds, what we're really seeing is if you have assets in a pan-Asia strategy that includes China exposure, that you're not likely to get a redemption in the short term. Maybe under the new administration things might change, but you won't get redemption, but it's harder to raise capital. It's definitely kind of harder to raise capital. But we are doing a lot of work on managers in Japan, like Derek was saying. Lots of trips for our team on behalf of, the clients are spending a lot of time focused on India and pan-Asia ex-China strategies. The contrast would be certainly the fastest growing part of our business is some of the wealth in the Middle East and those pools of capital. We've been advising clients there for almost 30 years, but certainly in the last 5 years, there's been a growth in demand, particularly family offices, and so they are definitely kind of allocating to strategies in Asia, but there's definitely a skew towards established firms as opposed to emerging managers. So that'll be
Great, thank you. Thanks everyone for sharing your insights today. I hope that the audience have found it useful and that you are able to position yourself in front of these allocators over here. So thank you very much everyone, it's been a pleasure.